Welcome back, traders and investors, to the first segment of our All About Crude Oil show. And we have two special guests on the line. The first one's Dennis Gartman. He is editor and publisher of the Gartman Letter. And Ron Insana. He's a CNBC contributor and author of Insana's Market Intelligence. Gentlemen, how you doing this morning?
Doing great. How are you guys? I'm doing well, but it's snowy and cold here in Southern Virginia. Global warming is running amok. It's 18 degrees, 40 degrees below normal, and we have 8 inches of snow on the ground.
The global warming, man, it's been global colding the last 2 years. Do you think they got this backwards and it's actually just making the globe colder?
Oh, no. Why would we say that? Clearly, this is a problem of global warming, obviously.
I'm actually in the little ice age camp, so I'm, as usual, somewhat contrary to conventional wisdom.
All right, get things started. Dennis, we'll start with you. You started writing your newsletter in 1987, and you think about where the crude prices were at that time, and then give us your historical perspective. I mean, when you started writing in 1987, price probably wasn't too far from where it is now. We've had a couple runs up over 100, 1 to 150. I mean, just put it in a historical perspective, $50 crude, I mean, seems cheap to me.
I would take exception to that. I think that $50 crude in my lifetime is relatively expensive crude oil. I can remember far too often and far too long that crude oil was $10, $12, $13 a barrel. We've seen it since that period of time. I doubt that we're going to get to $8, $10, $12, $13 a barrel again, but to me, in retrospect, $50 is relatively expensive crude. We especially with the futures markets and the term structure the way it is, with 2-year forward crude still at $65 a barrel, that's extremely profitable. People can drill, people will drill, and they can hedge forward. No, I will take exception and think that $50 crude oil is on average relatively expensive. I think that the $100, $110 crude oil that we saw several times was absolutely an egregious error, an outlier, two outliers that we had, and I doubt that we shall see that price again, certainly in my lifetime, but again, I'm getting into my middle 60s. I don't have that much of a lifetime left.
Ron, you were the anchor for the Financial News Network in the mid-'80s and covering crude oil. Could you give us your historical perspective on $50 crude?
Yeah. Listen, I mean, I agree with Dennis. If you go back to the last time the Saudis decided to flood the world oil market in 1986, crude oil prices went from what was about a record of $35 a barrel in 1985 down to $10, just under 10 on the spot price in 1986. And Dennis is right. I mean, historically, this is a very expensive market. When you look at crude oil prices from 1986 to 2000, the average price for a barrel of crude oil was about $15. Broke out after Saddam Hussein invaded Kuwait, and we then, of course, went in and liberated Kuwait, and the price immediately crashed after we did that. But listen, the equilibrium price for oil, I don't know exactly what it is. There's about a 2 million barrel a day oversupply in the world right now, which would suggest that 50 is a little bit expensive. The world could probably live with $80 crude, can't live with 110, and it'd be very difficult to maintain oversupplies if we get much lower than 40. So I'm kind of comfortable with the price right where it is. Don't know that it's fully bottomed out, though it seems like it might be in a bottoming process. But, for me, it's hard to tell. The world economy is still weak, so the demand picture now is as important as the supply picture.
What about OPEC? They keep cranking out production here. When do you think they back off?
I don't think that. I don't know. Okay, I'll let Ron go.
Or either.
Oh, look, I mean, this is the game the Saudis play for market share, which, again, going back to 1986, other members of OPEC were cheating, which was the word they used, on their mandated production quotas. Saudi Arabia was the swing producer and decided to flood the market with oil to punish the cheaters, drive the price down, enforce discipline in the cartel, and then get the price back up as they retook market share. It's kind of the strategy they're using with U.S. frackers. What we don't know, although we're seeing evidence that the Saudi strategy is working because some production in the United States is being shuttered, some layoffs have come, some reduced expectations for oil output from the fracking world have been pretty obvious. But the strategy will work temporarily. And working against the Saudis happen to be new technologies that may make ultimately, maybe in Dennis and my lifetime, I'm about 10 years younger than Dennis, crude oil obsolete in a certain sense. Natural gas has a much brighter future as a fuel than oil. So I think there's a stopgap by the Saudis that may work in the short run, or certainly may stop the bleeding from their perspective over time. But I don't think it's an endgame solution.
Dennis, what are your thoughts here?
If there's one thing that we can count on in this world, there aren't many things you can count on. Your dog will love you, your mom loves you, and the OPEC nations cheat. That's just all there is to it. They will cheat. They have cheated. They will cheat again in the future. If you are Iran, for example, you really don't care, or you can't care much what your cost of production is, and clearly it's well below where the current price of either Brent or WTI or even Dubai crudes are. If you're Venezuela, you really don't care. Well, you may, but you don't have much choice where your price of production is. What you care about is the subsidies that you have granted to your population in order to keep them quiet. The Iranians, the Venezuelans, the Saudis, the Emirates have all granted to their people enormous benefits accrued from crude oil. Let's consider the fact that the Iran probably needs something above $140 a barrel to meet its subsidies that it's granted to its public. That's really what's important to Iran. If crude oil is $50 a barrel, is Iran going to decrease production? Of course not. They're going to triple production if they could, because they need 140 or 150 to meet their cash requirements promised to their population. The population is getting uncomfortable in Iran, and the mullahs understand that. So will they cheat? Of course they'll cheat. Will Venezuela cheat? Of course it will cheat. Will the Saudis continue to be a large producer when the others are cheating? Of course they shall. That's the problem that OPEC faces, and that's the problem that crude oil itself faces. OPEC cheats. That's all you need to know.
And going into the cost of production for, the OPEC countries, I know some of them are, wanting to pull back the spigot a little bit. Where could you just give us the different countries in OPEC, and then for some of the U.S. companies, where the cost of production is, where they start, not being able to make money pulling crude oil out of the ground?
Oh, if you're the Saudis,
it's interesting.
Go ahead,
from a worldwide perspective, the cost of production in Saudi Arabia is roughly $2, and the highest cost of production in Canadian tar sands is north of 80. That's the range. I mean, so then let's take it from individual country perspective. Russia, Venezuela, and others are hurting because of the budgets that they have. Russia can't provide the subsidies that it provides with oil under $108 a barrel. So, the cost, to a certain extent, as Dennis says, might be irrelevant because they need just to sell. But the Saudis have the easiest, situation here insofar as it's $2 to produce. Even at $50, they're making a ton of money, and they have 4 years of currency reserves, so they don't care about their budget the same way Russia or Venezuela or Iran might.
And given if the Saudis have several years of reserves on hand in cash and equities and debt securities, the Venezuelans have practically nothing. The Russians have very little. Most of the other OPEC countries, Angola being one, are in dangerous fiscal circumstance. They really have no choice. They must produce, and it doesn't matter what the price of crude oil is. They have to produce. They will produce.
So, Dennis, what does this mean for the companies over here that cost of production is significantly higher? Like Ron was citing $80 the Canadian oil sands. What does that mean for these? Are these companies going to go out of business up there if oil stays down?
There will be some. If you are unhedged, and most everybody is unhedged past 2016. I don't know. I know very few oil companies who have hedged 2017, 2018, 2019 crude oil. Anybody who's really done a very good job of hedging probably at best is hedged out into 2016. If crude oil prices remain, if they get to where I think they could go to $35 or so and stay down there on the spot, the only thing that will save them is if the term structure of the futures remains at a magnificent contango and gives them the ability to hedge in the deferreds. But if you end up taking the crude oil the term structure to parity, which I don't think is going to happen, and we get crude oil prices to $30, the numbers of bankruptcies that will occur are going to be myriad. They will be large. There will be many. And anybody who doubts otherwise is naive. That's what's going to happen, I'm afraid. I don't like to say that. At the same time, that's a wonderful circumstance for the rest of the economy.
Absolutely. I mean, $35 oil equates to what? Maybe $1.25, $1.50 for gasoline, maybe $1.25. And so, that's a rather, as we always like to call it, that's an enormous tax cut for consumers, particularly middle-income and lower-income consumers whose share of disposable income is spent, is a greater share of disposable income spent on gasoline, air conditioning, and heating than anyone else. And so they get that extra, kick to their bottom line. And we've seen, in fact, restaurant sales. A friend of mine, Steve Blitz at ITG, had a great chart. When oil and gasoline prices started to plummet, restaurant sales started to go up. So we've seen consumers take advantage of lower prices. They bought more gasoline, clearly, but they're also able to eat out more frequently because it's cheaper to get around.
Yeah, guys as rich as Ron don't have to worry about that, but poor people like me, we have to do that. We can go to McDonald's twice a week instead of once a week with crude oil with gasoline prices at $1.50 to $1.75, $2 a gallon.
So Dennis,
I send Dennis a monthly check just to make sure he's okay.
It didn't get here this month, Ron. I'm waiting.
Yeah, well, it is in the mail, Dennis.
Okay, thanks, Mike.
Dennis, just going back to you on these thoughts. Okay, so maybe restaurant sales, some of the retailers might benefit. What about the airlines here? We know the airlines directly benefit. Are you bullish the airlines then if you think oil could go to $35?
Well, one should have been bullish of the airlines a while back. I wish that I had been. I wish I'd had enough sense to look at the second derivative of declining oil prices and realize how beneficial that was going to be to the airline industry. It's beneficial to Southwest. It's very beneficial to American. It's probably not nearly as beneficial to Delta because Delta went ahead and bought itself crude oil supplies and its own refinery, so it's probably not as beneficial to Delta as it might be to the others. But clearly it's beneficial to them. At this point, however, with the with prices of airline tickets as high as they are and as crowded as they are, I think people's propensity not to fly and instead to drive is greatly heightened. I think automobile sales will be a better beneficiary than shall be airline stocks at this point.
Okay, airline stocks had a pretty good run earlier on, and they've stalled here, and it's been pretty obvious that they haven't been able to make any headway. As oil's kind of bumped along the bottom. What is interesting is, Dennis mentions Delta having bought this, a refinery operation and locked in its own crude supplies. We should have known that was the top. An airline getting into a business it shouldn't be in, which is to own crude oil refineries and crude oil supplies. They did that closer to the top than the bottom. They probably would have been better off not doing it than doing it, given how steeply the price of oil has fallen.
We got a question coming out of the chat regarding perhaps this being a buying opportunity for the Chinese. With the oil sands cost so high, will the Canadian government loosen their stance on allowing foreigners to buy into their oil companies / production?
Well, if I were Chinese, I would be looking at buying everything I could get my hands on because China clearly is energy deficit, always has been energy deficit, and is always likely going to be energy deficit. So if I were the Chinese, I would be out buying everything I could get my hands on. I'd be buying Phillips 66 and Conoco. I'd be buying almost any energy company, especially any exporter I could find. Why would you not?
Ron, your comments on that?
Well, look, having said that, I think China has other problems at the moment. They're a beneficiary of lower oil prices, but I think that they're also suffering still from a lack of demand. I think China's economy is much weaker than people realize, and they have an oversupply of housing. They have an oversupply of almost everything. They have a pollution problem. So they have so many things to tackle simultaneously. I think securing energy at a low cost, which you're quite capable of doing right now just on the open market, is probably fine. And I think the political issues they have in trying to buy a Conoco or trying to buy a Phillips 66. Certainly, if they tried to buy a domestic U.S. company, they'd have a lot of trouble.
Not a question.
Yeah, they're out there trying to do energy deals with Russia and everybody else who'll supply them oil.
Yeah, the Chinese have been notable buyers of things in Angola. We don't realize how big a supplier of crude oil Angola is, but China has been in Africa and specifically in Angola for a long period of time. Why would you not?
Ron, I'm going to go to you on.
And I doubt that the Angolan government is going to put up much of a squawk if the Chinese come in and pay a nice premium for it.
Yeah, because they're so clean.
Yeah.
Ron, I'm going to go to you first on this one. So, okay, let's say oil does continue to go lower. What does that mean for alternative energy here, like some of the solar companies? Because if oil's cheap, isn't everybody just going to stick with their normal energy sources?
Well, yes and no. I mean, there was an interesting piece in the Journal yesterday about how electric car resales have fallen because the price of oil has come down and gasoline along with it. I would say yes and no. It really depends on a couple of different things. I mean, natural gas is becoming increasingly interesting, not only as a feedstock for manufacturing, but there is still an intense conversation about converting, let's say, the American truck fleet to natural gas, because natural gas is even cheaper than crude oil. And there are some incentives for continued, development of alternatives. Certainly electric is interesting. And at the end of the day, and I don't expect this to happen because of the way in which our political system is structured right now, an enlightened energy policy, which, number one, I think should subsidize fracking in the United States so that our producers aren't adversely affected by what the Saudis are doing. I think the U.S. government should insist on energy independence or self-sufficiency by a date certain in the future. But I also think that, with Chevy, for instance, coming out with the Bolt rather than the Volt, it'll go 200 miles on electricity. If we were smart enough to build out the electrical infrastructure and take advantage of this, we could get out of this situation entirely and be, certainly much less dependent on oil than we are now, much more dependent on electricity and natural gas, for which there is almost an unlimited supply. So that would be my preference. Whether it happens remains to be seen. But the short answer is, yeah, when oil prices go down, people buy more, they relax, and they stop worrying about alternative sources of energy.
Dennis, what are your thoughts?
I want to talk about natural gas for just a second, and especially in relationship to the numbers of people who are getting excited about the fact that rig counts in crude oil are falling off the edge of a cliff and then will fall even farther. But what's interesting is rig counts in natural gas production began to fall 2.5 years ago. There were almost 1,600 rigs in the United States drilling for gas 2.5 years ago. That's down to 300 rigs, and yet nat gas production is up over that period of time. People don't realize
we may see that. Yeah, we may see that in crude oil too, right? I mean,
yeah, exactly.
Rig counts are down, but the technology for fracking gets better. They're getting more out of existing wells. Yeah.
So when I see people getting bullish of crude oil because rig counts have fallen in crude oil from 1,600 to 900, rig counts in crude oil are probably going to go down to 400, and yet it's going to shock people that production will continue to increase. So be careful out there when you hear rig counts falling and you start to get bullish of crude. Take a look at what happened to natural gas.
Gentlemen, let's focus on the different subsectors in the oil industry, the drillers. From the conversation that we're having so far, Ron, I'll go to you first on this. Doesn't sound like you're adding any drillers to your portfolio.
No, I mean, listen, I don't think they bottom till it's certain that oil is bottomed. I do have in my portfolio Valero, which I added recently, and I had kind of I have an interesting love-hate relationship with that stock, but I actually love the company. And we're going into the summer driving season. They're refining flat out right now. They're profitable. They're raising their dividend. I mean, that's the way in which I would play this, because I think the demand for gasoline will intensify if, God willing, the United States ever, liberalizes further our ability to export both refined and crude products. I think this would have a major beneficial effect on the industry. But I like Valero almost singularly out of the energy stocks that I look at. E&P will be interesting when the consolidation process starts and the big companies start going after the marginal companies. And, I don't know if you're going to get take-unders or take-overs, but that's to me when things start to look a little bit more tantalizing.
That's another question there, too. Do you think we see more consolidation in the industry? Dennis, what are your thoughts there?
There's always consolidation in all industries, and there's always new entries at the margin. So that's my statement, and I'm sticking with it. What really has happened is fascinating to me is how much stronger has been distillate prices, how much stronger have been gasoline prices relative to the price of crude. So the expansion in the ability to refine crude oil, the refining margins have really gotten very, very large, and that has accrued to the benefit of Valero. One thing I'd like to talk about fracking, if I might, kind of from a humorous perspective. One, I think that the citizens of Pennsylvania should bend over backwards and thank the lunacy of the political stewards in Albany, New York, for having suspended fracking in New York. If I were a property owner in New York, I would be so irate if my fellow across the state line in Pennsylvania was able to sell his acreage for $1,900 or $19,000 an acre on an annualized basis, and I don't get anything. Two, let's never forget, God was not so suspicious and so segregationist in his policies that only the United States has frackable land. I suspect there's frackable land in China. I suspect there's frackable land in Russia. I bet there's some frackable land in South America. We have learned how to frack. Everybody else is going to copy us. And if you don't think that that's going to have an impact upon the production of crude in the next 15 years, you're naive.
Gentlemen,
and the fact it's our technology that might end up being used. Even though we don't have great relations with either China or Russia, if you pull away from those two countries and then you look at Latin America, where there's also frackable land, Mexico has opened up and liberalized its energy industry to foreign companies, that it's going to happen there as well. So I agree with Dennis wholeheartedly on that.
Gentlemen, you don't sound like you're real bullish on the drilling sector, exploration, and let's talk about the big oil companies, ExxonMobil and Chevron. Mr. Buffett exited his position in ExxonMobil. Those stocks do provide a nice dividend. They've kind of at least held in here. They're not going down like they did before. What's your thoughts on the big oil companies, ExxonMobil and Chevron? Let's start with you, Ron.
Well, I mean, history tells us that when prices collapse, they cut their dividends, they roll back on exploration and production, and they don't bottom really. I mean, they bottom a little bit sooner than crude oil bottoms. The energy stocks, from a historic perspective, tend to lead the underlying commodity market, whether it's oil or gold. That's typically the relationship we've seen over time. And I think if the energy stocks turn hard, we might have to reconsider our position. But look, I tried playing BP about 2 months ago because of that 7% dividend. I took a 10% hit in a matter of 2 weeks and got out of the position, without suffering any further damage. I don't know that they can bottom until everybody is convinced. And I don't know that this process ends anytime soon, really, as Dennis is indicating. Everyone is convinced that, crude oil has found a, sustainable low. And I thought, this rally that we had, and I wrote about this on CNBC.com and on Benzinga, I think that was just a massive short squeeze, the bounce that we had from 44 to 53. That's what happens when you have a straight line down. It's going to pop at some point, and now it's back under 50.
Until the term structure begins to tighten, until the front months gain upon the back months, and until they begin to do that, even on down days in trading, you just can't be bullish of crude oil. Period. End of discussion.
Dennis, that's a good point here, because I just want to get into this whole roll decay in the USO, and a lot of people, I have a lot of investors that talk about, I'm just going to buy the USO and hold on here because I know oil's going to come back, and they don't consider that roll decay and the contango there. Can you just quickly maybe talk about that, why USO maybe not the best investment, or what are your thoughts on that?
USO is not the best investment. The contango is very severe. The cost of carrying crude oil is wide and getting wider. As I like to say, crude is abundantly supplied, and crude is bidding to put itself into storage, driving the back months up, hammering the front months forward, and you're going to continue to see that contango widen. If you own USO, that roll down every month will just wear you out. If crude oil were simply to go sideways, which is what you can hope, I think, at best, if crude oil were to go sideways, you're going to lose about 11% a year right now.
Wow.
You may even start to lose 13 or 14% as the contango widens. You just don't want to own USO. It is a terrible, I hope I'm clear about this, a terrible way to be bullish of the crude oil market. Don't
And listen,
do it.
unless you're a professional, right, Dennis? I mean, understanding what the roll down means, and when contracts change over and the gap between pricing from 1 month to the next or 1 quarter to the next, this is really a professional affair. And some of these ETFs they have such large tracking error for whether it's an underlying index or an underlying commodity. You have to be pretty careful, and you really have to know your stuff. That's why a lot of these ETFs are traded more aggressively by hedge funds and quant shops than they are by individuals, and they become sucker plays for individuals because the pros know what they're doing and they understand this very component that you're talking about.
Gentlemen, we're coming near the end of our segment here, and we've touched on a lot of different things here. What should investors? I mean, should energy be a small portion of their portfolio? Should they look at this as a once in a lifetime buying opportunity? What?
I don't.
Wow.
Yes, it's a once-in-a-lifetime buy, and I hope you only buy it once. I hope you don't add to it as it goes down. That would be my opinion. I doubt that this is a once-in-a-lifetime buy. I think stocks generally are a much better purchase, and I think if crude oil simply sits here, which I think is the best that can happen, that's good for the economy. If crude oil goes lower, which I think that it shall, that's enormously good for the economy. Trade then accordingly.
Yeah, from an investment perspective, I go back to, again, like a Valero, we're seeing expanding margins. And typically, from a seasonal perspective, from here until July 4th, the refiners, do well on Wall Street. There's a seasonal trade as we gear up for the summer driving season. And so, Valero got beaten down pretty hard. It's come back a little bit. That's intriguing to me. Listen, I think, trying to catch the proverbial falling knife in oil is something that only professionals can do. So if individuals want to buy the USO, as a speculative trade, I think that's a little dangerous. That's a little too professional for them. And I think, once something bottoms, there's always time to get in. You don't have to catch the bottom tick. That's not what individuals need to do. They need to play trends. They need to play trends that are sustainable if they want to make money. And I think they can wait and let the pros get the first 5 or 10 or 15%. And play for that middle 60 or 70% and do quite well.
Gentlemen, thanks for coming on the show. Dennis Gartman, editor and publisher of the Gartman Letter. Ron Insana, CNBC contributor and author of Insana's Market Intelligence. Great information, guys. We will digest it. We'll look at it and hope to have you on the show again soon.
It was my honor. Ron, always good to be on a show with you, my friend.
And you, Dennis. We go way, way back.
Too far back. Back when we both had hair.
Yes, exactly.
Thank you,
Thanks
gentlemen.
a lot, guys.